That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joining us now with the latest market action. Jared.
Josh, I haven't seen this in a while. Let's take a look at the Dow on the Wi-Fi Interactive. You're going to see it's down over 870 points, 1.88%. S&P 500 hasn't had a 2% down day since some of those April lows, and we are down 2.7% right now, just wrapping up and getting some of those closing prints in. And the Nasdaq, meanwhile, down 3.5%. That is quite a sum. Small caps also down more than 3%. You can see that in the S&P 600 there. And I want to quickly tick through some of these other indices. The VIX, not surprisingly, up as that rises when equities tend to crash like they have today. Haven't seen a 21 handle in the VIX since April, and so that's something that we're going to talk about in the market takeaways in about 30-40 minutes here. And let's take a look at the sector action. Only staples, consumer staples, finished in the green. That's considered a safety sector. And tech, certainly no bastion of safety today, as it was down 4%. That's XLK right there. Also, energy underperforming, down almost 3%. Consumer discretionary, where you have Amazon and Tesla, down more than 2.5%, and industrials and financials and materials also down more than 2%. And taking a peek at the Nasdaq 100, a lot of dark red there. And you can see, especially in some of the mega cap names, we haven't seen anything like this in a while. Nvidia down almost 5%, same for Amazon. Broadcom up or down more than 5%. Tesla also down 5%. AMD, which has seen an incredible surge recently. And let's check out the 5-day total. Still in the green for 30%. So AMD holders still looking at some sizable gains for the week, but definitely not today. And taking a look at the Dow, few green spots, which are kind of part of the safety trade: Walmart, McDonald's, and Coca-Cola. Aside from that, you got IBM down 3% or plus United Health and Nike down more than 3 or 4%. And just switching over to China, which was really kind of the big deal as part of the headlines that we got earlier from Donald Trump, as he posted on Truth Social. Big losses there, mostly dark red, down 8, 9, 10% in some of these cases. And I'm going to switch over to the U.S. once again to show you what small tech is doing in the disruption. Looks like Roblox is in the green today, but semiconductors, shellacked, and software off considerably. And on that note, I'll send it back to you.
All right, thank you, Jared. Well, for more on the downturn in stocks as Trump threatens a massive increase on China tariffs, let's welcome in here Mike Dixon, Horizon Investments Head of Research and Quantitative Strategies. Mike, it is good to see you. So President Trump posts on China, obviously sounding frustrated. Mike, tariffs back in focus. I'm curious what you make of it, what you made of the market response and reaction, and whether you think, Mike, this is the start of something more serious for the market.
Yeah, hey there. Thanks for having me today. I mean, look, it was a pretty nasty reaction today. We haven't had this, as your prior guest was saying there, since April. But look, I think this speaks to more just kind of market complacency than anything. We've had just a stellar run the last couple quarters. And one of the things I like to look at to kind of gauge that sentiment is kind of, more risky stocks versus more defensive stocks. Of course, today we saw a lot of the defensives in the green, with a pretty wide gap. But, you go back to the April lows and, high beta, S&P 500 stocks are up over 60% compared to the defensives. And today you saw a little bit of that reversing. I mean, look, honestly, I think it is quite a healthy reminder that these kind of losses are possible. It's really hard to take a read on this tweet and extrapolate it compared to the swath of information that we're going to get next week with earnings, and those hard fundamentals over the next couple weeks, I think are much more important to pay attention to than the back and forth with tariffs that we have learned over the last several months. Could change with just a tweet.
There were, Mike, I got to say, there were technicians and their research had been landing in my inbox. And even before this, I know there were some chartists who had been saying, listen, that the market, in their opinion, had been kind of flashing some yellow lights, that underlying breadth was softening, for example, Mike. I guess what I'm wondering is, do you think there was just some group of investors who, listen, they had been waiting for a headline, they had been waiting for a reason to book some profits? Do you think that's in part what we saw today?
I really do think it is. I think where we are in markets right now, I mean, valuations have been, quite extended. I mean, we have, valuation levels for the S&P 500, as high as they were back in 2021. And when you have that much kind of, growth and low risk price in the market, any little piece of bad news, can cause something like you saw today. But I think that's really, really important as we head here into Q4 earnings, making sure, we're kind of positioned properly, for the next several months, as these, short daily, weekly moves are of course, extremely difficult to call. And so I do think there are some opportunities to look for, here in the fourth quarter, looking through a little bit of this haze that, is caused by some of these headlines and tweets.
So what you saw today, Mike, it didn't make you reconsider where you see some of those opportunities. Like for example, Mike, I see here you like small caps. But if you knew, Mike, hey, trade tensions are going to ratchet up, tariffs are ratcheting up, the heat was ratcheting up between U.S. and China, would you reconsider whether you want to be in those pint-sized names?
I think there's within the small cap space, there's a lot of diversity. There are, of course, much more cyclically exposed, junkier areas of that market, but there's also much more higher quality, domestic focused names in the small cap space. I think there's quite a few things working, in favor for small cap allocations right now as we head into the fourth quarter. I mean, tactically, one of the things that we saw present in the third quarter is just the level of interest rates. Small caps did quite well as interest rates have come down. And, at this point, I think, higher rates are almost completely off the table, right? So that's on the short term, something that's pretty good for small caps. A little bit more on the medium term, it's got to do with earnings breadth and, and valuations. And we've seen earnings breadth and earnings growth pick up meaningfully the last few quarters for the S&P 600 in particular. And valuations have not moved up in kind. And so what you've got there is very strong earnings beats the last few quarters. Analysts have not picked up their revisions, so the bar is still fairly low, and valuations are at quite healthy levels. And so you combine that with a little longer term thesis that it's an under-owned area of the market. I mean, S&P 600 is only up about 1% year to date. If you do get some of that weakness at the top and get a little bit of a rotation trade, I think some of that, more higher quality, positive earnings, smaller cap names could benefit a little bit on that rotation trade. And so that's one area I like positioning for here heading into Q4. And today doesn't deter me from that view.
Can I just ask you, Mike, quickly, what about the great AI trade? You want exposure there? I had another investor on the show this week, Mike, not as enthusiastic, said just looking too pricey to him at this point.
Well, look, what's driving the large cap space is the AI trade, of course, and it's the very, very top of the market of the AI trade. I think one of the things that we saw the last few months, take something like software and services, right? This is an area of the market that's going to, in a lot of cases, be bringing that AI to the broader masses. And they've kind of struggled a little bit over the last few months, in part because it's been difficult to separate, who really has a unique offering. And I really think that in the absence of being able to really pick those winners and kind of some of that like kind of phase 2, phase 3, AI sphere, I think the market's going to default to the big hyperscalers at the top end of the market, the Microsofts and Googles and Amazons and NVIDIA's, and you've seen that, Broadcom, Oracle, some of these big mega hyperscalers. I think you just cannot afford to be underweight those names as we head into earnings season. But I do think you can be underweight, some of the smaller mid cap, or smaller large cap names, and that's really I really kind of prefer that barbell portfolio of maintaining that mega cap AI exposure, but also kind of barbelling that with a little bit more strategic allocation on the smaller cap side of things for the reasons I just talked through.
Mike, always good to see you. Thank you, sir.
Yes, sir. Thanks a lot.
Investors flock into precious metals and cryptocurrency with more frequency, but moves in the Treasury market don't necessarily suggest the so-called debasement trade is gaining steam. My colleague Julie Hyman spoke with Michael Gucci at Principal Asset Management to help demystify the confusion.
The big story here is that there's inconsistencies around the behavior of the dollar this year versus the behavior of U.S. assets, whether that's fixed income related or even equity. We are seeing, that most of the demand still remains very high for U.S. assets, and the dollar implications are some of the uncertainty that your previous guests were talking about around government shutdown, tariffs, the place of the U.S. in the global world. But overall, we're in a position where there's a breakdown of that debasement trade.
And I mean, do you think there even is a debasement trade, or are people just trying to sort of describe something that's happening and put sort of rational parameters around it and trying to explain it in some way? Or do you think there was and it's faded? Like, what's happening here?
It doesn't appear to us that there has actually been a debasement trade, that there is not there. The dollar is a function of supply versus demand, just like any other asset. And when investors globally start to get concerned about the uncertainties that have evolved over the past 9 months of U.S. government behavior, they behave in a manner that's consistent with that concern in the value in how they're positioning the dollar. Tariffs are a big part of that, and so I think that there is a view that perhaps the U.S. dollar was a bit overvalued, and that's showing up in the way that it's traded this year, rather than there being this flight away from U.S. assets or concerns about the long-term health of the U.S. dollar.
Michael, as we take a step back and look at the fixed income market right now, at a time when the Fed is at the early innings of a rate cutting cycle, what does that imply then for investors and where they should be positioned within fixed income?
I think the big message I would leave is that there is a real need for income globally. You have an environment in fixed income which is providing that income today. Yields remain relatively high on a near-term historic basis, and investors should be thinking about opportunities to lock in these types of yields to create income streams on a go-forward basis. Historically, when the Fed is in a rate-cutting cycle, fixed income does well. You see the entirety of the yield curve decline. And so not only do you have the opportunity to create income today, but you also have the potential for total return in the fixed income markets.
Well, and that's an interesting argument, because we know that with yields in the last year or so, the highest that they've been in some people's investing lifetimes, if they're younger, sure. Right? So is it going to take some convincing to tell people, well, you should get in here even if you're getting a lower yield than you were a year ago?
I think there is some concerns that maybe that ship is already sailed and that people missed it. But as to your point, a lot of recent behavior would suggest that these are attractive entry points for getting into create an income portfolio again, or even a potential for total return. I am unfortunately old enough to remember trading much higher interest rates 20, 30 years ago. But the environment that we sit today, which is that there is more demand for income. There's more demand for fixed income from hedgers. It's unlikely to see that longer term interest rates are likely to be meaningfully higher anytime soon.
Wall Street assessing the optimism around AI with the heavy spending on artificial intelligence and its payoff. Yahoo Finance's Inez Ferre taking a closer look in the latest installment of the Investor Playbook. Inez.
Josh, one of the big questions this week is the AI trade overstretched? Have investors been buying too much into the AI trade? And are we in some sort of bubble? We saw earlier this week that Goldman Sachs said that this market is not in a bubble yet, pointing out that the companies with the highest returns are the ones with the strongest balance sheets. Also, UBS, a similar theme, saying that investors should stay engaged, pointing out that the companies of today that are leading the AI momentum boom are companies with a stronger balance sheet than their counterparts back during the dot-com bubble. And UBS saying that investors should buy the dip, except for today, there have been few dips to buy. If we take a look at our Wi-Fi Interactive, we'll note that okay, a lot of red on the screen today, but if we look over on the major averages and we take a look at a year-to-date chart, you will see that there has been quite a run-up on all three major averages, especially from the April lows, with the Nasdaq, the S&P 500, and also the Dow, really in this V-shaped rally that we've seen. So that has begged the question, are these valuations stretched? And there are certainly some on Wall Street Street that have been warning about a stretch valuation for these markets, saying that we are due for a pullback, not knowing exactly what the catalyst could be, except now perhaps the catalyst is the tariff situation and the trade war between the U.S. and China flare-up that occurred, and a fluid situation there. And one other point is that when we are looking at the earnings that are going to be announced next week, yes, Wall Street is expecting that the AI trade will continue, but Wall Street also anticipates and will be looking out for any companies that talk about tariffs, because even though the tariffs on other countries and it's been a fluid situation, they are certainly less than back in April. And so what will the impact of the final tariffs on certain countries? What will that impact on those goods from certain countries be for companies? That's the question to see, but still, Wall Street has already increased its price targets on the S&P 500, thinking that the AI trade is the one that's going to power the markets higher.
All right, thank you, Inez. Well, Disney making waves this week, announcing new ticket prices into its Disneyland and Disney World parks during peak times. One day, single park tickets for Disney World and Disneyland will now cost more than $200 for the first time. Most other tickets for Disney World are going up by an average of $5, and Disneyland is keeping its lowest price ticket the same for the slower season. But the increases are being paired with some hotel discounts, raising some questions about the health of the consumer. Joining me now is Matthew Dolgan, Morningstar Senior Equity Analyst. Matt, it is good to see you. So this is interesting, Matt, kind of puts and takes here. So per reports, during the busiest days of the year, Matt, tickets in Florida go to $209 plus tax. Per CNN, this is the first time Magic Kingdom tickets crossed that $200 threshold. For Disneyland Resort in California, the peak ticket goes up by nearly 9% to $224. But then also, we see these sort of notable discounts, Matt. So I'm reading here, up to $250 off per night on packages at Disney World. And I guess, Matt, listen, I'm an investor, and I'm listening to all that. Bottom line, what is that telling me, Matt, about what overall park demand looks like?
Well, it's tough to really get a bottom line out of that because, like you said, we've seen some conflicting messages. Generally, the parks have been pretty strong, but I do lean a little bit to looking at some of those discounts and thinking the consumer might be a little bit weaker than he and she has been. And it's a reason why we're a little bit cautious over the next year or two on Disney's parks. So we think these parks are great assets. They are really a reason why we like Disney as much as we do. But despite recent strength, we think there are some warning signs that should make you cautious if you're expecting experiences results, which is the segment that that the parks report in, to just keep growing at the rate they have recently.
There are some folks, Matt, I know they actually study wait times at the parks. They see it as maybe a line of sight into attendance. I'm just curious, as a financial analyst who knows the company, do you study those kind of variables?
We have not looked at wait times much. The thing that we've been thinking about quite a bit, though, this year, because we brought down some of our estimates earlier in the year, and in the couple of quarters since, the results have been really good. But our view is that maybe some of these headwinds, if you see especially less tourism into the U.S., they're not showing up yet. And so what's going on at this very minute may not necessarily be an indication of what's going to happen in 2026 with vacations having been booked in advance.
As investors, Matt, we focus a lot on Disney's streaming services. Can you remind us as investors how important parks are financially to the business?
Yeah, well, at this point, still, parks are by far the biggest contributor to operating profit. So last fiscal year was about 56%. We expect it to be similar this year. And part of that is because the streaming business, which, as you mentioned, is really important for this company, is maybe the highest profile part that gets the most attention, hasn't been profitable. So we do expect that on a normalized longer term basis, parks won't be this make up this big a proportion like they have recently as streaming becomes more profitable. But we still think more than 50% of the profits for the next 5 years for sure are going to come from parks. So as far as the profit this company generates, it really is parks most important.
Do we have line of sight, Matt? I'm curious into just what costs are like for Bob Iger at these parks. Labor costs, construction costs, food prices, and whether the price hikes, how much they could help protect his margins?
Yeah, they do break some of those out, and margins have been expanding. It is the case that we expect that some of these price hikes, which happen as a matter of course pretty much every year, are to offset the inflation that the company is seeing on costs, and to help offset that. And the company has had the pricing power to do that. So that has not really been an issue as far as rising costs hurting the company. And it is a reason why we expect every single year generally to be getting price increases. But I think it's the level of those, first of all, that are one thing to keep in mind. They weren't quite as big this year. And then second of all, at some point, if attendance does become a drag, and again, we haven't seen that yet, but we're concerned that it might be the case, you've got a lot of fixed costs in this business. And so even apart from the inflation, you might see some margin pressure, which is something we're watching for again in the next year or two.
Matt, earlier this year, you cut your fair value estimate as macro weakness, foreign tourism boycotts. You do know that hasn't quite materialized yet. Do you think we get maybe more insight into this next earnings report?
We probably will. The next earnings report is going to conclude the fiscal year 2025. So at the outset of a new year, we'll probably get a little bit more color about what the firm expects in the coming year. You're exactly right. We took down our numbers, and we haven't seen some of that play out yet. We haven't raised them, but haven't raised our numbers. But that's really the reason why we are as comfortable with Disney's stock as we are. And that's not to say there's not going to be a lot of headline risk. And if the consumer weakness does show up and there's macroeconomic weakness, we'd expect the stock to sell off. But because that is built into our numbers, and we've got the company slightly undervalued now, it really gives us even more confidence over the longer term that this is a company to own. But investors do need to be aware that it's subject to swings on news, and it is subject, its business, to macroeconomic volatility.
Matt, always great to have you. Thank you.
Thanks, Josh.
Time now for what to watch. Starting off on the earnings front, it's that time of year again. That's why we're talking about earnings season. A lot of reports coming up. Big banks will be kicking us off, including JP Morgan, Goldman Sachs, Citi, Bank of America. JP Morgan announced results for the third quarter on Tuesday. Analysts expecting the largest U.S. bank by market cap to post strong Q3 results, driven by trading and wealth management. But it's also facing higher costs and upcoming rule changes that could shape its 2026 outlook. Taking a look at the Federal Reserve, we're going to be getting a close eye on upcoming commentary from multiple Fed officials. This is coming after some comments from Fed Governor Michael Barr on Thursday. Barr calling for a cautious approach toward further interest rate cuts, emphasizing the possibility that tariffs could create persistent inflation. And taking a look at Washington, looks like that government shutdown is dragging into another week. The Bureau of Labor Statistics saying it will publish the September Consumer Price Index on October 24th. The data was originally scheduled for October 15th. The delay potentially impacting the Social Security Administration's ability to calculate the cost of living adjustment, often referred to as COLA, for the following year's benefits.